Hello and welcome back to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today. We're covering our asset allocation recommendations for the near future. As I mentioned in the first segment, if you missed it, come visit us on the web, www.dlblain.com. But we were talking in the first segment about how we're encouraging investors to take a somewhat longer view. Don't bury your head in the sand and forget about your investments, but try to stay out of the day-to-day gyrations of the marketplace. And we're talking a little bit about kind of where we see opportunities for investing. We're talking about the equity market, which is what most people always think about first. We divide the world up into 6 regions, and these are done by what we call market capitalization. If you add up the number of shares of companies multiplied by their share price, you come up with what's called market capitalization. So it's the amount of dollars that are invested in the shares of all the companies headquartered in a particular stock market. Well, not necessarily headquartered, but traded on that exchange. So for example, in the U.S., we would add up all the companies that are traded on the U.S. exchanges, multiply it by their share price, and you come up with a dollar figure. You do the same thing with Germany and Japan and the United Kingdom. Anyway, so on that basis, on a market capitalization basis, the U.S. makes up approximately 43% of all the world's companies. Next behind the United States is Japan. That's somewhere around, say, 10%. The United Kingdom is somewhere in there, 8-10%. So those are the 3 largest markets in the world. As we drop below the United Kingdom, we aggregate into these larger regions because the countries get a little bit too small if you were to target. So the next one is the Europe outside of the United Kingdom. This would be Germany, France, Italy, Spain, Portugal, those type of economies. The next market is emerging markets. As I mentioned in the first segment, the 4 largest emerging markets are Brazil, Russia, India, and China. It also encompasses places in Eastern Europe, such as Slovakia and places like that, as well as Asia, such as Vietnam, things like that. Then the last region of the world that we break the world into is what we call the Pacific ex-Japan, meaning all the countries in the Pacific outside of Japan. This would be like Australia, New Zealand, those type of countries, the developed countries. So we come up with 6 regions: the U.S., Japan, the United Kingdom, 3 single countries because they're the 3 largest by market cap. Then we move into Europe outside of the United Kingdom. Of course, they're not part of Europe anyway, but just for clarifications, Europe outside of the United Kingdom, emerging markets, which are not regional based, but they're all over the world. And then the final region that we look at is the Pacific outside of Japan. And so of those, right now, we're overweighting the United States and just recently moved back to overweighting in emerging markets. We think that their decline has been overdone. They've got good fundamentals going forward. We're currently underweighting Europe outside of the UK as well as Japan. These are some of the economies in the world that are the slowest growing. They have the most aging population. Their demographics are all wrong. Their social policies, they're way too top heavy. You think we have problems here in the United States. I was listening to someone about Spain. The Spanish unemployment rate is like 21%. And the unemployment rate of Spanish youth is 42%. It's double the rate of the regular unemployment. Can you believe it? 21% unemployment. Now, of course, their socialist policy in Spain is the way their economy is designed is they have approximately 70% of the population is guaranteed a job with great benefits, early retirement, health care, everything. And then the other 30% are not guaranteed anything, and it's mostly the young people. And so they're out there sort of fending for themselves, subsisting on below minimum wage. And so Spain has basically made the choice that they're going to give 70% of the people everything and 30% of the people nothing. And I know, I'm not a international relations expert, and I know that's probably an oversimplification of the Spanish economy, but it's pretty accurate. And they do have a 21% unemployment rate. It's mostly those in the 30% that are just sort of ignored. Anyway, the point is that there are other countries in Europe that way. So there's just a lot of problems in Europe. So we're continuing to underweight Europe. There are some decent companies in Europe that are global in nature, but Europe as a whole, we keep a small allocation towards Europe, but just not real excited about what's going on in Europe. As far as the other asset classes, currently bonds versus cash, you just can't make anything in cash. So we would recommend that at a minimum you invest in some short-term bonds. If you need some liquid money, some safe money, you just cannot make anything in cash. After inflation, you're going backwards. And so at a minimum, we would like to see people invest in short-term bonds versus keeping the money in cash. Within the equity portion of the market, we're also emphasizing growth and small companies once again. Different companies are categorized by their valuation levels as well as their size. And right now we're emphasizing companies that are considered growth companies as well as the smaller companies. And we just moved back to smaller companies from a neutral allocation. We're coming up on our second break. When we come back, we'll continue going through our current outlook. So for All Things Money, I'm your host, David Blain.